Hi, good evening, everybody. Thank you for dialing in today. Today's webinar by Stashaway, we're going to be the title is Building Wealth Your Way and using the right investment strategy for you. So you'll be here with me, Albert and Jack. And as a quick introduction about ourselves, I am the Deputy Country Manager here in Stashaway, Malaysia. And prior to joining Stashaway, I used to be in the fund management industry at Affin Hwang Asset Management. So I bring that investment experience here to Stashaway. And here we have Jack. Jack.
Hi everyone, my name is Jack. I'm the client advisor here at Stashaway. So I have been in Stashaway for more than 3 years now, helping clients look for the best portfolio to achieve their personal financial goals.
All right. So okay, that's a little bit about us. And for today's session is actually a follow-up from the previous webinar which we did on flexible portfolios. So for those of you who aren't familiar with what flexible portfolios are, they allow you to be in control in terms of creating your own portfolio for yourself. So essentially, you can pick the asset class that you want and choose what allocations go into them, and you have the flexibility to change them at any point in time. We did that webinar previously about a couple of months back, where we went through in detail about what flexible portfolios are. If you have missed that, or maybe you've forgotten some things, you can rewatch them again by going through the QR code that you see on the screen here, or going through the bit.ly link that you see at the bottom. So it's bit.ly/flexible portfolios. All right. So flexible portfolios, also just as a recap, is one of the various offerings available on Stashaway. So as you can see on the screen here, there we are live in 5 different countries. So there's Singapore, Malaysia, MENA, Thailand, and Hong Kong, which flexible portfolios is available. This is in addition to the other offerings we have. Predominantly, when we started out with general investing portfolios at Stashaway, then we expanded that into BlackRock. So as you can see on the screen, there are the other offerings available there. Okay, so to set the tone today, here we're trying to find what is the right investment strategy for you. And how we have kind of split that up is in two, we're going to tackle it in 2 ways. So firstly, finding going through what is the style, investment style for you, there's active and on passive investment styles. And then the second part is identifying the 2 investment processes that you can use for yourself when investing. One is asset allocation and security selection. So as we kickstart today, Jack will start it off first, then it will be me covering the investment process part. So on to Jack right now.
All right. Hi everyone. So I'll be starting off with explaining 2 of the, spectrum of the investment style. One is active investing versus passive investing. So let's start off with, explaining the definition of what is passive investing, right? So the definition of passive investing is essentially just buying and holding. The keyword here is a diversified portfolio. So this kind of portfolio usually tracks a market index, so like the S&P 500, right? And the goal of it is actually to achieve a return that is similar to the market. So you're not trying to beat the market in any way. You're just trying to achieve the market return, right? Okay, so some of the key features of this, because you're just buying and holding a portfolio that tracks the market, essentially you wouldn't have a lot of changes in your portfolio composition over time. So this means that the portfolio turnover rate would be rather low, and it also focuses on the longer term, right? And moving on to what is active investing. So active investing is basically making more specific investment decisions, whether it's about a company, a country, or even a sector. So this kind of decisions can be made based on your own individual research, your analysis, right? And the goal of it is basically to outperform the overall market index. So you want to outperform the S&P 500, for example. So this gives you a chance to do so. And some of the key features of it is obviously if you are a very active investor, you would have a high portfolio turnover rate. So meaning that the composition of your portfolios would change quite often, and your investment decisions would be based on more short-term factors that are impacting the market as well, right? So even things like valuations and short-term movements in a stock or in an index, right? So moving on, I guess a lot of you here would have a lot of famous active investors out there. So, but it's actually easier said than done. So let us go through three kind of questions that you can ask yourself before you even decide if active investing is the way to go. All right. So these three questions can be separated into time, meaning do you have the time to do your own market research, right? I guess a lot of us here are working adults, so and thinking about your commitments to your family, things like that. Do you have realistically, do you have time to do your own market research? So if let's say you have the time, do you have the knowledge? Do you know how to do market research? Do you know the data to look at? Do you know some of the models to use, things like that. Finally would be the views. So do you have a strong belief on a specific company, a specific sector, to even think about doing active investing, right? Okay, so just a kind of a quick recap on the pros and cons and also the attributes of passive versus active investing. So if you're investing more actively, you would have the ability to express your views on certain market movements by essentially overweighting maybe certain sectors or even certain companies, right? And to this, you would have the potential of achieving higher returns. But this comes at a cost where if you're using a broker, for example, you might incur higher brokerage fees because of your frequent trading. So this is essentially something you need to consider before you go into active investing, right? So obviously, the main thing here is that it requires a lot of time, a lot of effort, and also you need to have the knowledge to even begin your journey here, right? For passive investors, you are essentially just buying an asset class or like an ETF that tracks a specific index efficiently. So this means that it should have low tracking error, it should have low management fee. So from this, you would have a lower trading fee, so it doesn't eat away your returns, and you don't really need a lot of time to do this, right? You don't even need a lot of in-depth market knowledge to get started with this. Okay, so now that you know a little bit more about the different investment styles, the two spectrum of it, how do we apply it to the investment process? So I'll let Albert take over this part.
All right, thanks, Jack. As we go through today, also a quick reminder, if you have questions based on what we just talked about, just feel free to post them in the Q&A chat box, and we'll get to them towards the end of the session. But yeah, as Jack mentioned, now that he has explained what active, what passive investment styles are, now I'm going to go into the investment process itself. I briefly mentioned at the start that there are two steps within the investment process. So firstly, there's the asset allocation, and second, security selection. Some of you may be familiar with what these two are already, but I'll just for today's purposes, just for completeness, I'll explain the meanings of these two. So asset allocation it involves the process of determining in a strategic manner how to allocate or distribute your funds to different asset classes out there. So examples of asset classes can be stocks, it can be bonds, it can be things like commodities, such as gold. So that's what asset allocation involves. On the flip side, security selection, which might be something more familiar to us today, it involves the process of choosing within each asset class itself what investments to do so. So say within equities, I want to invest in a company XYZ, for example, or bonds, maybe I want to invest in a certain corporate bond issued by this company. So it's a little bit more nuanced in that sense for security selection. And maybe if based on what I just mentioned, you have a harder time to kind of understand it, I'm just going to share with you a slide here to help you visualize how it looks like. So asset allocation is the process of determining how much of your portfolio should you put into these different buckets or columns that you see here. And each column here represents an asset class. So you can see you have US large cap equities, you have emerging market equities, you have gold, for example. So say you have a portfolio where you want to invest 50% of it into US large cap equities and another 50% of it into gold. So that is an example of asset allocation. On the flip side, for security selection, that's where you go within US large cap equities itself to determine, say, I want to invest in Microsoft, for example. So that is security selection, a little bit more, I guess, more precise within that asset class itself, what you want to invest into. And so, given that Jack talked about earlier, active and passive, I just talked about asset allocation and security selection. You can actually plot them on the chart that you see on the screen here, whereby it goes on the spectrum from passive to active for both asset allocation and security selection. So where do, I guess, investment products lie within this chart that you see on the screen here? So here are a couple of examples. If you look at the top right corner, you have hedge funds, which are typically more on the active side on asset allocation and also security selection. On the bottom right corner, you see that you have private equity funds, you have mutual funds, or even sector-specific funds that tend to be more on the active side with security selection, but not as active on the asset allocation side. And then on the bottom left corner, you have your broad market, your index funds, which purely aim to track a specific index where they are both passive in asset allocation and security selection. So these are just very broad examples. There could be some certain exceptions where they may be placed in different parts on this graph, but this is just to give you an idea of what's available out there and applying the framework that we just talked to you about. So for StashAway itself, right? I briefly mentioned earlier at the start about our general investing portfolio. So they sit in roughly in this middle section here where they are not active, so meaning they are passive on the security selection side, but they are more towards the active area on asset allocation. But for today's intents and purposes, we're focusing more on flexible portfolios itself, right? So flexible portfolios, where do they sit in this chart? And they are actually on the more passive side towards security selection, but what they do enable you is to adopt a range, a spectrum from being very passive to being very active on the asset allocation side. So this is, I guess, one of the interesting things about flexible portfolios of StashAway that can enable you to express your views or your investment approach, whether being more on the passive side for asset allocation or being more active on asset allocation. So here, I just want to, I guess, drive home the point, because we have talked about this before in past seminars, whereby we have asset allocation, you have security selection, which is better. If you look at research that has been done out there, asset allocation is responsible for more than 80% of a portfolio's return over time. And that's why we believe that when it comes to your investment process itself, you should focus predominantly more towards asset allocation, and you can say a smaller portion of it towards security selection. And then you may be wondering, Albert, why should I not focus on why not security selection, right? Should I just pick stocks? And I would ask you, how easy do you think it is for yourself as a retail investor or a non-professional to beat the S&P 500, right? How easy is it for you to beat or any other benchmark out there? So sharing with you some examples here when it comes to professionals who manage money within the US itself. You have your large cap funds whose mandate is to invest in large cap companies. About 93% of them underperform their benchmarks over a 15-year period. So, these are to drive home the point home again. These are professionals. Their job is just to monitor the market and beat the benchmark. If you think that this is an issue that is only limited to just large cap funds, actually, when it comes to mid cap funds too, about 93% of mid cap funds within the US itself underperform the benchmark over a 15-year period. Subsequently, if you look at the small cap funds out there, 94.35% of them actually underperform their benchmarks. So this is I guess this is not only applying to small cap funds, but also applicable to medium and large cap funds. You might be thinking then, Albert, is this US specific only? Could it be other countries too? So just sharing, I guess, on the next slide here, a little bit more information about other countries, right? What are these? What are the stats here? What are the percentage of funds here that underperform their benchmark? It's not really just a US problem. It's actually also applicable to the others, right? So as you can see, in Europe, Brazil, Australia, and India, these other countries, a significant portion of funds there underperform their benchmarks. I'm taking this from SPIVA itself. So these are numbers that you can also Google up yourself. But yeah, here the point that I want to bring home is that we think you should be focusing more on asset allocation when it comes to your investment process. Less so on security selection, but we're not entirely saying that you should not do security selection. You can allocate a portion of your portfolio maybe towards security selection, but majority of it should be focused more towards the asset allocation side of things. Okay, so again, to help visualize help drive home the point and have you visualize where you should be focusing your efforts on is towards the shaded blue area that you see on the chart here, right? So we want to be take a passive approach when it comes to security selection and take a bit more, I guess, you can have passive towards an active approach when it comes to asset allocation. And so within here, this is what flexible portfolios enable you to do, whether you want to take a bit more on the passive side towards asset allocation or towards the more active side when it comes to your asset allocation. So I hope that gives you an idea of how you can think about it when it comes to investing towards your goals out there. Now we'll do a quick demo in terms of how you can use these flexible portfolios, how you can see them in action and apply it to your own context. Okay, so time for a quick demo right now. Jack will lead it off.
All right, thanks, Albert. So I'll be demonstrating using my phone here on how you can use what we just said earlier on setting up your own flexible portfolio. Give me a moment to share my screen. Okay. All right, so I'm using a Singapore demo account here, so it might differ a bit depending on where your region is, right? So say, Albert, you want to set up your own flexible portfolio, right? And then you're considering the few questions that we asked earlier, whether you have time, knowledge, and also view, right? So going on the first question, do you think that you're someone that has a lot of time on your hands?
Maybe not as much because I have a family, I have kids to take care of, and I have my day job. So maybe not as much.
All right. Okay. So in this case, if you don't really have a lot of time, so I would encourage you to use a more passive approach to the for the flexible portfolio here. So moving on to the second question would be, given that you don't have a lot of time, what is your investment time horizon for setting up this passive style portfolio?
I think for me, I would like to invest for like a 10-20 year period, that kind of a long time frame. My ideal approach would be a bit more passive. I don't need to be too hands-on. So that's kind of what I'm looking for.
All right. So 20-year period is quite long. So it definitely helps if you have quite a bit of equities in the mix, right? So let's say we set up a flexible portfolio consisting of just the S&P 500, right? So I'll demonstrate how you can do this using the flexible portfolio on the app, through the app, right? If you have followed our previous webinar, you might have or you might have seen this on how to set up the portfolio. So on the home screen itself, you can scroll further down And then you should be able to see the flexible portfolios under the featured portfolio. All right, just tap on it. And okay, so this is more specific to Singapore, but I'll just choose to fund it using my personal bank account and create a portfolio from scratch here. And I'll click continue. Okay, so you can choose or look for the specific ETF in the list that we have here, right? Or you can use the filter function at the top, tap on it. And under asset classes, you can filter for US equities, apply filter, and you can view the rest of the selections here. And scroll down a bit, and you should be able to see the S&P 500 ETF here, right? So just tap on the plus icon and continue to adjust allocation. All right, so in this page, you should be able to allocate essentially all of the portfolio, or 99% of it, into the S&P 500 ETF that we have. So just tap done and click continue. And you should see the risk level of this portfolio, how this portfolio would have performed across different time, and different things like the exposure of this portfolio, etc. So I just click confirm. All right, so here you can click done reviewing after you review the portfolio. And I don't want to make any deposits now, so I just tap the X icon at the top.
All right, great. I think I have my own portfolio that invests purely into the S&P 500 right now. I guess that's more towards on the passive side of things. But what if, say, I have a portfolio that is positioned for a stagflationary environment, which is what we're going through right now. And I want to take a bit more of an active approach whereby I feel, we're entering a recession. So how can you run me through the process on that, Jack?
Yeah, sure. So if you already have a portfolio, for example, I have one pre-set up here, right? So this portfolio itself has some assets, which I'll show here, that some of these assets are in our current general investing portfolio that's optimized for a more stagflationary environment. So if based on your own research, your own analysis, you think that you're seeing something that everyone else isn't seeing, and you think maybe we are entering into a recessionary environment and you want to change up your compositions a little bit to position yourself for a recession. Maybe you think that you should be earlier than everyone else, right? So looking at some of the asset classes we have here, you have some global equities, government bonds, commodities, and some short-term treasury bills, right? So if let's say you're thinking that we are going into a recession very soon, and inflation might be coming down, so you don't want the ex-US inflation-linked bond ETF to be in your portfolio, and maybe you want to even add some more protection into the portfolio itself, right? So what we can do is tap on the three dots icon at the top right corner here, and tap adjust asset allocations. Right, so from here you can add or remove assets. Just tap on it. Okay, so I see that something that is more interesting is that we have a bond ETF that invests in US investment grade. So this can be something that is more protected, right? So if you want to have more information on to look for more information about this ETF, you can tap on the eye icon, and this is what you see. A short description of what the ETF is, how the ETF has performed across different time, and top exposure, and something very important is also the expense ratio. So if your view is that maybe you think the US Fed is going to cut interest rates, so you want to lock in a higher yield right now, and this is a high quality bond, so you would have more protection, and you want to change into this ETF, or you want to add this ETF into a portfolio, you can go back to this page and tap on the plus icon at the right hand side, and say you want to remove the initial WIP ETF from your portfolio, right? So you can find it here under government bonds. So just tap on the plus icon again and continue to adjust allocations. All right, so you see the disclaimer there, you are removing something from your portfolio. Okay, so tap on it, and now you should be able to see the new asset allocation that you have in the portfolio. Just tap on it and change it to match 100% of your portfolio, or to add it to 20%, so that your portfolio comes up to 100% in total. Right, so just tap continue from here, and you'll see the changes in the risk level. It actually went down, so it went from a balance to a moderate risk level, and you'll see how your entire portfolio would have performed across different time, right? So on top of that, you'll still see the different exposures, sectors, the regions, and we can click confirm here. Okay, so your portfolio allocation has been updated.
Right. Great. So that's the demo, everybody, for this session. I hope you kind of learned something new in terms of how you can operate within here. Let me share the screen again. Okay, so oops. All right, so as a quick recap of what Jack just went through earlier, we did two scenarios. So the first scenario was whereby we wanted to create a passive portfolio that just tracks the S&P 500. So from an asset allocation perspective, that's the passive approach. In the second scenario was whereby we went through a more active approach in asset allocation. So you have a portfolio that's positioned for a stagflationary environment. But say the economy enters a recession, how can we take a bit more active approach towards changing the composition of that portfolio itself? So what Jack showed was that we removed our inflation-linked bonds and replaced it with US government bonds in there. So that's how you can utilize flexible portfolios in a way to express your views in an active manner or in a passive manner in terms of your asset allocation. Okay, so that's it for today's session. I will jump into Q&A, and I think there has been a couple of questions in there already. So that we'll kind of get to it right now. Please feel free to add further questions if you have, and we'll get to it. Okay. Okay, so the first question is, so yes, I shared earlier about the percentage of funds that underperform the benchmarks in various countries. So here we have one about India. You see that the India fund manager underperforms index. Which fund manager am I referring to? So I'm not specifically referring to any one fund manager. I'm just talking in totality itself. So not selecting one name. But if you want to get that information, just Google up SPIVA, SPIVA, and you'll be able to see by given the statistics, which countries out there how have they performed versus their benchmarks. Okay. So next question is by Joe. Maybe Jack, you want to take it? Joe is here asking, why would you leave 1% in cash for rebalancing? How does that work?
Yeah, so the 1% cash is actually not specific to the flexible portfolio. It's actually common across our portfolio offerings, except for things like statutory simple. So the 1% cash is also used for things like if there are any fees collectible from the portfolio itself, we also first deduct it from this 1%, so that we don't really need to sell off your assets to collect the fees themselves, right? So this is on top of, if let's say you make a very small withdrawal from the portfolio itself, we also first take it out from this 1% to ensure that it is, we fulfill this withdrawal the fastest way possible. Then we'll start maybe replenishing this 1% through selling off some assets. So it works for a few different purposes. Yeah.
All right. We've got the next question, which is 0.8% per annum management fee is quite steep for a self-directed investment portfolio. Will there be a different tier of management fees for flexible portfolios once the no fee promotion ends in June? Yes, there will be. So just to clarify, right now, for those of you who are keen to try out flexible portfolios, it is free to use until the end of June. After which the new fee, which we will officially be announcing soon, but you will hear from me here first, is that it will follow the normal tiering of 0.2 to 0.8%. So essentially, and you'll start at the 0.8% tier first, and as you invest more, then it gets lower and lower. So the exception being in that if you only invest or you create a flexible portfolio with one ETF in there, like the one that we just did earlier for the S&P 500, then the management fee will be 0.3%. So that's the I guess the exceptional case. But other than that, it will follow the 0.2 to 0.8% tiering that is specific to the country. So it's a little bit different in terms of the tiering for each country in terms of the bands, but 0.2 to 0.8% is the one that's relevant for you. Okay. Okay, next question by Ming Fu. He's saying you seem to focus much on the US itself. How about Hong Kong and Singapore ETFs? On this question, Ming Fu, if I understand correctly, the ETFs, when you say that we focus much on ETFs, I presume you're seeing that these ETFs are just happen to be listed in the US itself. So even though that they are US listed ETFs, they do offer exposure to different other countries, different sectors all around the world. So you're not getting US exposure per se, you're getting other countries, different sectors. But having said that, we are always on the lookout for other ETFs out there that might be interesting, that might meet our internal criteria in terms of liquidity, etc. So like when you mentioned Hong Kong ETFs, Singapore ETFs, yeah, they might be something that we will include down the line. Right now, we have a slightly over 55 ETFs that is available for you to kind of pick and choose for your own flexible portfolios, and we will certainly be adding more later on. Okay. Now the last question from Smith is, what's the difference between treasury bonds and bills? Can you take that, Jack?
Yeah, sure. So treasury bonds and treasury bills are very similar in nature. They are both issued by the country's treasury, right? So treasury bonds are usually, the term bonds are usually for a longer term. So if let's say the bond is issued for 10 years and above, we usually call them bonds. If it's issued for a very short term, like maybe a year, then they are usually called bills. So there isn't a lot of difference. There are some more technical difference, like for example, bonds usually they pay out a coupon. On bills, usually they will be issued at a discount, and then you get the face value at the end of the tenure or the period, right? So these are some of the smaller differences, but essentially they are the main difference on how you use bond and bills are just that they are issued for different time periods. Yeah.
And if you want to learn more about, say, an ETF that invests in treasury bonds or bills, click on the little eye icon on when you see on the StashAway app itself. It allows you to go a little bit more deeper into what those ETFs are really about. Okay, and similar question, I guess, which was answered earlier. Vic here is asking, will there be more ETFs featured in the flexible portfolios? The short answer is yes. We are constantly on the lookout for more ETFs out there. So yeah, just we'll let you know by marking those new ETFs by a new sign there when you see them on your StashAway app itself. Okay. I think that is all. I think we have one more question that just came in. I guess this is on fees itself. So seeking further details on the 0.3% fee for one fund flexible portfolio. What is the fee if I have multiple one fund flexible portfolios? So in that case, yes, it will still be 0.3% applied to each of those funds that you have out there. All right. Okay, no more questions for now. Any other questions? I'll just pause for another 10-15 seconds to see if you have any more questions. If there's no more questions, I hope that all of you have found today's session helpful. If you want to learn more, we have questions relating to flexible portfolios or even any other portfolios that we have out there, do feel free to reach out to us. We're here, support@stashaway.com. If you have the Stashaway app, you can also drop us a WhatsApp, and we'd be happy to help you out with your queries. Okay, but in that case, that's it for today's session. Hope you all learned something, and thank you everyone. Good night, stay safe, and take care.
Thank you, everyone.
All right, bye bye.